All right, we are at the bottom of the hour. Welcome, everybody, to the Hendricks Wealth and Estate Management webinar series, coming to you live from our studio in our offices in Algonquin, Illinois today. I'm Jim Hendricks, the owner of Hendricks Wealth and Estate Management, and I'm up today in our weekly series of webinars. We do these every Wednesday at 11:30 Central, 12:30 Eastern. And today's topic is You're a Millionaire. Congratulations. Now avoid these common millionaire mistakes. As time has gone by, becoming a millionaire back when I was a kid, it was really something to be a millionaire. And I personally didn't know any millionaires back then. But now, having $1 million of invested net worth is becoming more common with inflation. And when people get to their first million, a lot of times they are prone to making mistakes. And it's very imperative if you're going to live the lifestyle that you're going to need to want, or that you're going to want to live, or that you need to live in your later years, that you don't make mistakes once you do start to become a high net worth household. So we're going to talk about the common mistakes today that people make, and we will have areas. We have time for questions and answers at the end. So you'll see down at the bottom of your screen, there's a little Q&A icon, and you can click on that and you can ask us questions. We'll do our best to get to those during our presentation. This is also going to be broadcast later as part on our Facebook channel, and will also be available on our corporate YouTube channel, and as well it will be on our website. We keep a log of all of these on our website as well. So without further ado, let's get rolling here today. So you're a millionaire. Congratulations. Let's start talking about what mistakes people make. Well, a lot of times when people get to a high net worth position, they got there because of an overly concentrated position. A lot of times this happens with things like employer stock. And you can get employer stock if you work for a large company. You might be compensated with equity in that company through the form of RSUs. RSU stands for restricted share units. If you own some of those, you likely know what those are. Those are generally given to important employees at companies in exchange as a form of compensation, and those are restricted as to when you can sell them. So in general, it's a great benefit to get. It's extra money in your pocket, but it could also lead to being overly concentrated in one position. You might also receive stock options as part of your compensation, or you might get grants or other awards, or you may have the opportunity to buy your company stock in your 401k. Well, all of those things could lead you to being overly compensated in your own company's stock positions. And we call that, or I like to call that, double jeopardy, because when you own a lot of stock in your employer, not only does that put your portfolio in jeopardy, but if something bad were to happen to your company, then your primary income source, your salary, your earnings, could be put in jeopardy as well. We try to caution people to diversify. I'll talk about that a little bit more in just a minute here. But also another way that sometimes people build up one overly concentrated position is maybe you made a little gamble on one stock position and it went really, 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 really well. There's a lot of companies out there that have gone up quite a bit over the last 20 years. And if you bought a company 20 years ago that wasn't worth very much back then, but it's worth a whole lot now, and you've never sold any, then you're probably over allocated to that one position. So many people who do make their fortune with one position end up losing their fortune due to that very same position. And again, I'll talk about that a little more detail in just a minute here too. A reason people keep these positions would be just an affinity to the company. If you've made a lot of money with the company, you kind of take a liking to the company. Same thing with your employer stock. You might keep your employer stock because you really like the company that you work for. And there's nothing wrong with liking the company that you're working for, but again, it can put you in a bit of a double jeopardy position by having your income and your portfolio both tied to the fortunes of the same company. Another reason people sometimes stick with overly concentrated positions is because they're afraid of the tax consequences of selling those positions. So if you've got a really large capital gain in a position, you might be fully aware that if you were to sell some of that, that could trigger a fairly large tax bill. For some people, that could be as high as 23.8% of their gain. And that will be enough to keep people from selling that position sometime. But better to sell a stock position and pay 23.8% in capital gains than to lose all of that position by something bad happening to the company, particularly if that company represents an overly large piece of your overall net worth. Going on here, just a couple studies that I'm going to highlight here. According to Ned Davis Research and Eaton Vance is a mutual fund company, 69% of all U.S. stocks experience a catastrophic loss. And by catastrophic loss, we mean a loss of 70% or more from their peak. And once they experience that loss, only 11.8% of those ever made new highs. Morgan Stanley did a study a couple years ago on concentrated stock positions as well, and they found that 60% of stocks that significantly outperform the market over a 5-year period become underperformers over the next 5-year period. And so the recommendation we have for these situations is to diversify. Don't let yourself be one of these people who has an overly concentrated position in any one position without taking some of that off the table and spreading it around, so that way if a bad thing happens to that one overly compensated position that you have, it won't ruin you financially. It's a wise thing to diversify. Tools that you have at your disposal to diversify: sell some of your position and buy pooled investments. By pooled investments, we mean things like mutual funds and exchange traded funds. Now, you might know what those are, but if you don't, I'll just briefly explain what they are. A pooled investment product is where basically and we use mutual funds and ETFs quite a bit in our practice. And what we're basically doing is we're hiring some nerds to buy and sell stocks or bonds on our behalf. And instead of taking our money and buying just one or two stocks, we're able to buy literally thousands of companies in some cases by having these nerds and by pooling our money with some people all over the country's money. So in a mutual fund, you've got owners of this mutual fund that live all over the country. They're pooling their money together, and then that money, that pooled subset of money, is being used to buy stock positions or bonds or investments in a wide array of investments. And we want to make sure that you're exposed to multiple sectors. You don't want to own just big companies or just small companies or just technology companies. You want to spread things around across the whole economy, and that includes geographically as well. You don't want to be all concentrated in the United States, but you don't want to be all concentrated in one country across the globe either. You don't want all of your investments to be in Japan or China or any country. You want to be geographically diverse. And you don't want all just rapidly growing companies or all just dividend paying companies. You want to spread it around those types of companies as well. So to give you an example, before I get into the next topic, I'm going to share a story that I often tell to clients when we're talking about overly concentrated positions. And that is about a company called Bear Stearns. You've likely heard of Bear Stearns before. And they were one of the darlings of Wall Street from as long as I can remember, all the way up to about 2008, 2009, when we went through the housing crisis. Well, there was a documentary several years ago right after that housing crisis happened. And I'm going to paraphrase just from myself watching that documentary many years ago. The documentary showed employees of Bear Stearns taking the Staten Island Ferry across whatever that would be there, the Hudson River, going to their jobs in Lower Manhattan and reporting to the Bear Stearns headquarters. And they focused on one floor of the building. One floor of the building had a very large number of mid-level managers working on this one floor of the building, and they reported that their average salary was about $250,000 a year, quite a good salary back in 2008. Also, Bear Stearns employees were being forced to put their 401ks into Bear Stearns stock. So these people that had these $250,000 salaries also had, in some cases, upwards of $500,000 in Bear Stearns stock in their 401k portfolio. So their income and their portfolio were both kind of married to the same company. Well, overnight, when the housing crisis happened back in early 2009, Bear Stearns basically closed their doors overnight, and their stock price went from, I believe, if I'm recalling this correctly, I believe the price was about $89 a share at the close of business one day, down to $2 a share the following day. And the doors to Bear Stearns were literally locked that following morning when the employees tried to show up for business. So not only did they lose their income, their nice jobs with their nice $250,000 salaries, they also lost a great deal of their portfolio by all that stock they had in their company in their 401ks. And we just don't want that to happen to anybody that we're working with. So we highly encourage people to avoid that double jeopardy and diversify their portfolios. And by working with us, you can kind of get up the timing. If you have RSUs, we can help you determine when the best time to sell those would be, what the ceiling should be on how much you should own in any one position. A good rule of thumb is we don't want one position to be more than 10% at all under really any circumstance in your portfolio, but usually we're shooting for 5% or less as well. And again, we can help you come up with a plan that's suited for you if you talk to us. Okay, creeping on. No pun intended here. Lifestyle creep. So lifestyle creep is as you go through your career, you tend to make more money. And a lot of times when people make more money, they won't increase their spending or their savings rather. They'll increase their spending, but not their savings. So we want to make sure that as your income goes up, so does your saving. And a good way to do that is to just automatically set something like a 401k to be X% of what you make. So that way, as your earnings go up, so will your dollar contributions to your 401k. But beyond that, we usually encourage people to increase their percentage every time they get a raise. So if you're putting 5% into your 401k right now and you get a 4% raise at work, split that raise with your 401k. So keep 2% for yourself, give 2% to your 401k if at all possible. Very often in our office here, we get people sitting across from us, and it's kind of funny. No matter what people's income is or no matter what their lifestyle is, just about everybody tells us that they're frugal. And they try to tell us, sometimes that they can't afford to put more into their portfolio, but yet we see people from all walks of life, people who make very low wages and people who make very high wages, comparatively speaking, all say that they don't have room to add more into their savings. Well, obviously, some people make ends meet with different amounts of income. We do want to just try to help you devise a plan that will allow you to increase your savings as your income goes up. Because again, a lot of times people don't realize how much they're spending on the little things. I know when I was doing my own budget many years ago, when I was even trying to put my own budget together, I didn't realize that I was spending so much on Target. So it took an analysis on my own part to realize what I was spending at Target, and that didn't really fit very nicely into any of my buckets that I'd had in my budget. It wasn't necessarily a grocery bill. It wasn't a clothing bill. It was more just like this stuff that we were buying at Target, and it wasn't accounted for when I was doing my very first budget, probably 25, 30 years ago. So you don't always realize how much you're spending, but by working with a financial advisor, they can help you realize how much you're spending on your lifestyle, how much you'll likely want to be able to maintain as a lifestyle going forward. And the best way to do that is to increase how much you're saving as your income increases. Another thing that we see people doing is, now that you're getting to be a higher net worth investor, there's this desire to act like a sophisticated investor. And a lot of times people will get involved in these buzzwords and they'll want to do things because, hey, that's what rich people do. And you get this fear that you're maybe missing out on something. You hear that your neighbors are investing in a hedge fund. Ooh, I want to be in this hedge fund. What's a hedge fund? I want to be involved in that. And here's a list of some of these buzzwords that we often see people coming into our office. Hey, what's this? What are these hedge funds about? I want to be invested in venture capital. I want to be in private credit. What are these alternative investments? I hear there's these tax havens all over the place. What do I need to do to get into those? Generally speaking, and I'm not saying that these things are bad necessarily, but I'd also say that you should resist the temptation to feel like you're a sophisticated investor, because for our investors that we're working with, high net worth, medium net worth, low net worth, we're generally doing the same types of investment products for all of them. And the reason is those are the tried and true things that have historically worked out in favor of the investor over the long haul. And anytime you add some of these little buzzwords, you're often adding expense into the equation. You're oftentimes, almost by design, building in lower average annual returns, and you're adding some complexity. You might be reducing liquidity. So there's usually some type of catch involved in investing in some of these things. Again, not that they're all bad, or not that they're bad at all, but there certainly are instances of bad examples within each of these things. So you just want to be careful that you're not trying to keep up with the Joneses a little too much by becoming too sophisticated, or trying to feel like you're missing out on something by not being invested in pick your favorite one out of this list of 5 things here that I've got listed. And there's others too. Sometimes, I mean, crypto was one. Again, I'm not saying crypto's bad, but you don't want to go overly invested in crypto just because you feel like that's what the rich people are doing. Having a very, very small allocation to crypto might be okay, but it's certainly not something you would want to jump into hook, line, and sinker. And in general, we just try to discourage people from buying things that they don't understand. If you don't understand it, it's probably something you either shouldn't invest in or you should have somebody explain to you exactly what it is so you can understand it before you put your hard-earned dollars into it. We tend to use in our practice things that are very, very simple, not very complex. Mutual funds, exchange-traded funds. That's the lion's share of what we do in our practice. And those are very basic investments. People sometimes feel like they're a little boring, and that makes them want to do something more. But really, when push comes to shove, these investments that we've used have stood up very well historically against most of the other things that you can invest in. Again, history is not an indicator of future results. I always have to say that when talking about historical returns. But we use those things because they're tried and true and because they stand up very well against just about everything else that we could possibly be investing in that's available commonly to investors. I'm going to have an example here. So I'm ending some of these stories with an example. I spent some time living out on Maui several years ago, and a lot of people on Maui got involved in this investment called the decentralized hedge fund. And this decentralized hedge fund was promising people 12% returns year over year. And anytime anything's promising returns, I run as far the other direction as I can, particularly if that sounds like it's something more than what like a bond or a CD might offer at like a 5 or 6% annual rate. If something's promising 12% per month, that definitely sounds too good to be true for me. And I had friends and acquaintances that were talking this thing up. And I try to caution them, hey, just be very, very careful. Proceed with extreme caution here. A lot of people did get involved with it. And people kept saying, oh, this is going great, Jim. I'm getting my 12% every month. Every month I get a statement. It's 12% higher than last month. Well, after a couple of years, when people tried to pull their money out, there was no money to be pulled out. And it turned out the whole thing was a scam. And it had very, very, very serious repercussions. I won't get into the details, but it has very, very serious repercussions for many, many people out in Hawaii. And those people never did get their money back. So you got to be careful when you're trying, and they wanted to do it because they felt like, hey, this is a hedge fund. This is what rich people are doing. They're getting 12% per month, so I can do that too. So you just got to be very, very, very careful and make sure that you understand what you're buying into. Another common mistake that we see people make is that now that you're getting to be a higher net worth investor, you might be underinsured. As your net worth grows, you should very likely consider purchasing an umbrella insurance policy. This is something that's fairly inexpensive. You can talk to your insurance representative, your homeowner's insurance representative, and they'd probably be more than happy to quote you on an umbrella policy. Basically, an umbrella policy is a policy that kicks in when your primary homeowner's insurance runs out. And it covers, I'm not an insurance guy, so I'm not licensed to speak about exactly all the things that it covers, but it basically steps in and covers all the overages that you might experience when your basic coverages run out. And it can provide a lot of protection against for your net worth. If you're sitting on a 7-figure portfolio and you've only got, say, $600,000 of coverage through your homeowner's policy, if you were to be liable for something, then an umbrella policy can potentially step in and provide protection where your homeowner's policy would have lapsed, or not lapsed, but been maximized. Also, if you're self-employed or a real estate investor, a corporate structure is a good way to provide a great deal of protection, either by forming an LLC or an S corporation. A lot of times real estate investors, particularly if they own more than one property, you'll hear of something called a series LLC. That's when, if any bad thing happens at one property, each property has its own LLC attached to it. So if something bad happens at one property, then the owner of those properties can't be liable and have to pay up in the form of liquidating a different property because each property has its own level of corporate protection in an LLC. For a small business, even if you run a small home-based business, you can create yourself as an S corporation or an LLC. And again, as long as you handle things the right way, you get corporate protection there, which protects your personal assets against corporate liabilities. So if you're Let's say you're a realtor and you're getting in your car and you're driving around from home to home and you're not organized as an LLC or an S Corp. If you get into a car accident, people could potentially sue you for your personal assets, even though you were acting as a real estate agent when you were driving from A to B. So that potential exists. So having that corporate form of organization helps protect you against things like that. And in most states, it's much easier to incorporate than you might think. You don't need an attorney to do it. Our office is here in Algonquin, Illinois. In Illinois, you go to the Secretary of State's website. You look to see whether your name that you want to have for your company already exists or not. And if it doesn't, for a relatively small filing fee, you can incorporate and you can get the paperwork done by yourself, and you can go a long way towards being incorporated within the first half hour that you visit the Secretary of State's website. So it is relatively simple to do, easier than you might think, and it's not that expensive to do, and you get a great deal of protection for it. Another thing that we're really focusing on in our business here is not having an estate plan. You'd be surprised how many people don't have estate plans. In fact, one of the most common things we get with new people coming into our office here is, yeah, I know I've always been told I need to have an estate plan, but it's just something I've never gotten around to. I need to do it. Well, get around to it and do it. As your net worth increases, so does your need for a written estate plan. And a basic plan will include a trust, powers of attorney for both healthcare and financial matters. Those are two separate documents, one for healthcare, one for financial matters, and a will. Uh, it's funny when people talk about estate planning, the will is always what they think about first. But in a well-executed estate plan, I would argue that the will is maybe the least important of those four documents that you see there: the trust, the healthcare power of attorney, the financial power of attorney, and the will. The reason for that is if you do things the right way, then most of your financial assets will not be subject to anything that's in the will. You'll have named beneficiaries and or a trust that will handle how all of your financial assets will be transferred. And by having a named beneficiary or a trust, that is more efficient, faster, and avoids probate, where a will is slower, more expensive, and does not avoid probate. Believe it or not, it's estimated 38% of households with a net worth in excess of $1 million do not have an executed estate plan. That number is astounding to me. 38% do not have an executed estate plan. Even more staggering is that 32% of households with greater than a $5 million net worth lack an estate plan. I'm going to show you a list of names here. These are people that have all passed within the last several years that passed without having a written estate plan. And you just think some of these are just amazingly, I can't believe that these people didn't have an estate plan. But Tony Bennett just passed not too long ago. Anne Hesh, Gilbert Gottfried, Norm MacDonald, Chadwick Boseman, Aretha Franklin, Prince, Amy Winehouse, Michael Jackson. Believe it or not, Michael Jackson actually did go through the process of creating a trust, but never funded it, which is a pretty common mistake that we see. So his estate has been disputed. Stieg Larsson, that's the author of Girl with a Dragon Tattoo. He was, I believe, a Swedish resident, and he had a falling out with his father and brother. He did not speak with his father and brother, but because he didn't create an estate plan, the intestacy laws, intestacy meaning you die without a written estate plan, in Sweden dictated that his estate went to his estranged father and brother. He died suddenly at age 49, I want to say. I might not have that exactly right. But his assets went to somebody that he very likely would not have wanted them to go to because he didn't bother to write out an estate plan. And again, it's very, very common that we see this. We are very, very, very laser focused on this in our practice, and we're getting more and more focused on it all the time. We have resources in place to help you create an estate plan. And if you do not have one, please, please, please talk to us so we can help you take that step toward creating a written estate plan so we can make sure that your assets are handled in the way that you'd prefer. God forbid something should happen to you. Okay. This is another big one. Inherited funds. People who inherit money, and we see this in our practice all the time, people who inherit their money find a way to spend it. 90% of wealthy families' fortune is completely gone by the third generation. They call that the third generation curse. A Texas Tech studies, now these two studies kind of contradict with each other a little bit, but the point I think still gets across. A Texas Tech study found that 42% of heirs spent their entire inheritance within 12 months. And again, I can't say that that's inconsistent with what we've seen in our practice as well, even though we try to keep people from spending that down. It's funny how once people find money, it's like they needed it all the time and they find a way to spend it down. Ohio University did a similar study. They found that 33% of all beneficiaries completely exhausted their inheritance within 2 years. So again, there's a little bit of a gap between that 33 and 42%. So those don't necessarily agree with each other, but I'm sure that's attributable to where the study was conducted, the types of people it was conducted on, and so on and so forth. But the moral of the story is that a very high number of people who inherit money find a way to spend it very, very quickly. Whereas self-made millionaires are almost 4 times more likely to maintain their wealth. So if you make it, it's a lot harder for you to spend it, and it's a little easier for you to maintain it. So if you're in line to receive a great deal of money, or you're going to get an inheritance, please, please, please work with professionals who can try to build a plan, who can tell you how much of that you can afford to spend every year so that can be something meaningful for you for the rest of your life. If you have a lot of money and you're trying to protect it for future generations, you can create something called a spendthrift trust. I'm not going to go into the details of what that is here today. We don't have time for that. But if you want to learn more, please feel free to reach out to us and we'll be happy to talk to you about it. And then beware the tax collector. So this is another thing. Once you get into be a higher net worth, there are several states, 12 of them to be precise, plus Washington, D.C., that have estate taxes at the state level. So here's a little graph with them and a list of those states. Again, our office is here. Our primary office is in Illinois. Illinois is one of those 12 states that have an estate tax. And if your net worth is $4 million or higher when you pass away, then your estate will be subject to Illinois estate taxes. There are things you can do to mitigate that. And then also some states have, 5 states, have inheritance taxes. Kentucky, Pennsylvania, New Jersey, and Nebraska will tax you just for inheriting something. Maryland actually is the only state in the country with both an estate and an inheritance tax. So if you have an estate, you're going to get taxed on your estate, and then Maryland will tax your inheritors on it, your beneficiaries. There are many, many strategies to help mitigate this. Credit shelter trusts. Again, I'm not going to go into details of what those are, but we'll be happy to talk to you about it. Gifts while you're living up to the annual federal threshold, which is $19,000 per person per year. So you can give anybody you want $19,000 per year, and there are no gift tax ramifications on that or estate planning ramifications on that. That money will be outside your estate. You can use something called irrevocable trusts. 99% of all trusts are revocable, but the way to help avoid estate taxes is to use an irrevocable trust. Again, I won't get into the details of what those are, but if you think this might affect you, we'd be happy to talk to you about it. And charitable donations, or if you're worried about state estate tax, you can always just move to a state that does not have a state estate tax. That's all about for these common mistakes that we see for high net worth individuals as they're getting their first million and moving on to becoming a high net worth investor. Again, we do these every Wednesday. We're not going to do a webinar next Wednesday. Next Wednesday, we've got a live event at Oak and Alchemy for those of you listening in Illinois. That's in Woodstock, Illinois. And the subject is going to be Ask a Financial Advisor Anything. So if for people who are showing up, it's an opportunity to just ask any question you'd want of our staff of financial advisors and financial planners. The following week, July 1st, on his birthday, Jim Madel will be up talking about senior lifestyle solutions with a guest speaker, Amanda Nelson from Senior Lifestyle Solutions. Sean will be the following week talking about settlements, inheritance, and windfalls. Choosing the right advisor is critical. Kind of dovetails into what we talked about today. And then the following week, a pretty hot topic, Dan Leitner will be talking about Trump accounts. Those are being launched on July 4th, and Dan will be available to talk about those on July 15th during our regular webinar series. All right, I'm going to open it up for questions. Right now, it doesn't look like we have any questions out there, but if you have questions, please post them using the Q&A button down on the bottom of your screen. I'll be happy to tackle those. Again, this webinar will be available on our website, also on our Facebook page, and our YouTube channel as well once we close this off today. And again, we have offices in Bradenton, Florida, and here in Algonquin, Illinois. There's a picture of our staff, and our Illinois office number 847-428-3997. Our Florida office number 941-308-9862. All right. I'm going to stop sharing my screen, and now you get me in our studio here. And again, we've got just a minute or two for questions if anybody does have them. I'll still hang out for a minute in case we do have questions. Usually we get at least one or two coming in, but so far nobody today.
You did too good of a job, Jim.
Yeah, well, if there are things that we couldn't really get into in much detail today. For instance, the details of what is a credit shelter trust, what is an irrevocable trust, how do these things work, how do you go about setting these things up. Does get a little complex, but that doesn't mean you shouldn't do it. And again, I'd encourage you if you are starting to become a higher net worth person and you don't have an umbrella insurance policy, talk to your insurance person about getting an umbrella policy. And again, if you've got a very highly concentrated stock position, please, please, please don't let anything bad happen to you by just something bad happening to that company through no fault of your own. Diversify that holding and make sure that you can't be hurt by something bad happening to just one company, especially if that's going to be out of your control. The way you can control that is by diversifying. All right. I guess with that, we're just up against the half-hour mark. I will close it with that. Thanks everybody for attending, and we'll look forward to seeing you in a future version of our webinar series. Thanks again, everybody. Bye bye.
Take care, everyone.